Good morning and welcome to the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. Here are the stories we're following today. Joining us now is Jim Caron. He is the CIO of Cross Asset Solutions at Morgan Stanley Investment Management. Jim joining us here from New York City. Thanks for taking the time to chat with us. Can we start with the Fed? Because today, if you look at the Fed speak, it seems like policymakers are really preparing the market for a slower rate of easing. Is that a fair statement?
I would say that's a fair statement. I mean, look, the data has come in. If we look at retail sales, if we look at the CPI data that has come out, I mean, the Fed says that they don't look at the equity markets, but the equity markets have been doing very well also. But when you put it all together, what we have to understand is that the Fed does want to cut interest rates, but they want to cut interest rates on the condition that inflation stays anchored around target levels, or is at least making progress to target levels and will remain anchored there. If that doesn't occur, if they believe that there is some threat to inflation starting to rise and move higher, or just not go down, or not continue to make progress lower, then I think that they're likely to think about walking back some of the pace at which they may want to cut rates. But make no mistake, they are cutting rates. They're going to cut interest rates. It's just a question of how much and how fast.
So you alluded to the equity market. We're just off record highs right now. Do you think financial conditions, generally speaking, are a little too easy for the Fed right now?
So, I would say the basic answer to that is yes. So when we think about financial conditions, I think it's important that we define what that is. And it's an index. It's a measurement of five things: short-term interest rates, intermediate-term interest rates, the value of the equity market, the trade-weighted value of the dollar, and also credit spreads, triple B credit spreads. So if we look at credit spreads right now, credit spreads are very tight. I mean, yields are still, I know they've come up recently, but they're still relatively low, but spreads are still extremely tight right now. If we look at the equity market's very strong. Bond yields, like I said, have come up, but they're still relatively low. So putting that all together, I would say that the financial conditions are somewhat easy right now. I wouldn't say that they're overly tight, and they may be too easy to continue to push inflation lower sustainably and durably to keep it around target levels. So when the Fed looks at the equity markets, it's not just the equity market that they're looking at. They're looking at it across a blend of different things that we call financial conditions. And I think that their assessment is that, well, look, inflation is making progress lower and it's okay for right now, but they don't want to push it too far, get too easy, and stoke those inflation fears again.
It's very interesting to see the price action in the bond market today and the spike in yield right across the curve, more so at the long end. And I'm wondering whether or not the market is beginning to understand the risk, the potential for inflation maybe to drift up a little bit, that the Fed doesn't yet have a firm hand on controlling price action.
Yeah, so when we look at this, we typically measure the yield curve, and the yield curve has been steepening as of recently, and I would argue that a steep yield curve is really just the normal state of affairs. It's a question of how steep, though. So the measurement that I want to look at, which is typically what the Fed looks at, is the difference between the Fed funds policy rate and the 10-year Treasury yield. Now, that spread on average is usually around plus 75 basis points. Currently, at this point, it's still inverted. And it's inverted quite substantially if we think of Fed policy rates around the 4.75 to 5% level and the 10-year Treasury at about 4.2%. The curve is still reasonably inverted at the moment. So if the Fed cuts interest rates, let's say their terminal policy rate gets them all the way down to, say, 4% or 3.75%. Now, I know the market's saying that they do more, but let's just say that they go from 3.75 to 4. The question is what is the spread between that Fed funds rate and the 10-year Treasury? Let's say it's positive 50 basis points. And that would put the 10-year Treasury around 4.5% with a Fed policy rate at about 4% or even 3.75%. So that's the dynamic that's being played here. The Fed can control front end rates, but they can't control back end rates. Back end rates can stay stubbornly high while the Fed controls those front end rates and drives them lower.
So in your view, everything that you're kind of laying out there in terms of interest rates, what does that mean for the equity market?
So when we think about this, I'm going to really start with valuations, right? So when we think about valuations, valuations are effectively, think of it as almost a measurement of a discounted cash flow. So it's like the present value of future cash flows. And the valuation typically comes in as in the form of a multiple. And the multiple right now in equities is somewhere around a 22 PE. Now, historically, that's kind of high. But we also have to recognize that if interest rates are relatively low or expected to go lower, then those valuations, those multiples tend to be a bit higher. So if we take that, set that aside for 1 second, that multiple and that valuation, then we look at earnings. What's earnings? Earnings is people's opinions. It's what their forecasts are. It's what their views are for what they think the S&P 500 collectively will have in earnings. Right now, that consensus for 2025 full year earnings is around $280. So the question for us is, if we assign today's multiple at 22, and we multiply it times that $280 earning, you're going to get an S&P valuation of somewhere around 6160, which is, higher than where we are today. But if those earnings settle back down, if they go down a little bit, meaning if interest rates go up and those valuations come down, so you go from a 22 PE multiple to a 20, then you're looking at, still with a $280 earnings estimate, now you're looking at an S&P 500 that could go to 5,600, which is below where we are by a few percentage points. So the market's debating this. Higher interest rates will depress some of these multiples lower, whereas lower interest rates help boost those earnings and help boost the valuations in terms of the PE multiple. So what I would say is that together, the market is expecting the Fed to cut rates, and some of that is supporting today's current 22 PE multiple. But if the Fed doesn't deliver on those rate cuts, it's not going to be good for the equity markets, because that PE multiple will start to come down, valuations will come down.
Step back from the equity market, look at the overall economy. Could we see a resurgence in growth? And if that's the case, do I want to be more exposed, let's say, to small cap stocks rather than some of the large multinational names?
Absolutely. Look, so if we get a resurgence in growth, so we get a cyclical recovery, if that happens, typically what that means is that the market broadens out, right? So we start to move into these broader sectors of the marketplace. Small caps in that environment, if you get growth, if you get broad growth, most likely would do very well. Now, the question, though, is if we get that growth. What most people are thinking about right now is we're getting a slowdown, right? So why would the Fed be cutting rates if we're expecting a lot of growth, right? They wouldn't be. So they're cutting rates because they expect there to be a growth slowdown. And I think that's what most people believe, and that's the soft landing. That's the narrative today. But if that narrative changes and it changes into a growth story, then the Fed's going to stop cutting interest rates. And if you get that growth, then I think the markets could broaden out and small caps could do well. So small caps doing well is conditional upon that view.
So we've talked about the macro. Give me your perspective on the industry groups that you expect to outperform at this stage of the cycle.
So, typically speaking, I mean, we know what has been doing well, right? So we know utilities obviously has done very well. Maybe that's sort of wrapped up into the AI story. So technology has been doing well. Industrials also. But you know what? Where I think the future lies is I'm more interested in some of the lagging sectors in the marketplace, and that's going to be materials. So look, if the U.S. is onshoring, if that's the big move for the U.S., that's the CHIPS Act, that's the IRA Act, where deglobalization, I think materials can actually do reasonably well. Other areas like, for example, healthcare. Healthcare is another segment of the economy. Now, clearly generally it's political. So, it depends who's in office and what the policies are. So that's why it's going to trade at a little bit of a discount to maybe where it could. But I think once that gets settled, I think ultimately healthcare sectors start to do, can start to do well. Consumer staples, those are other areas too that I would argue that have been lagging behind a bit that could actually do, reasonably well going forward, particularly if the market broadens out. And that's really what we're looking for.
So I hear what you're saying when it comes to reshoring. You mentioned the CHIPS Act. I'm wondering whether or not it's more prudent to be exposed to a market like, let's say, Mexico rather than the U.S., following with this nearshoring theme.
So I would say absolutely yes in the long term. It's going to depend on who is in the White House and what policies are. But I think the broad story is, absolutely. I mean, Mexico in many ways could be, the U.S. is China, right? You do a lot of manufacturing in Mexico in import, but clearly there's got to be a lot of trade agreements that get made in order for that to happen very effectively. So Mexico's just gone through their own round of elections, and there's been some volatility there. But I would say that as a broad, longer term theme, I think that's correct. But right now, we are not overly invested in Mexico only because we want to see how U.S. policy gets established, because Mexico could be subject to some pretty big swings. So it's a good idea. I just need a bit more information.
All right, Jim, we'll leave it there. Thank you so much for making time to chat with us. Jim Caron is the CIO of Cross Asset Solutions at Morgan Stanley Investment Management, joining us here from New York. Joining us now is Peter McGuire. He is the CEO of XM Australia, on the line from Sydney. Peter, it's always a pleasure to have a chance to chat with you. I'd like to begin with the Fed, because we had a couple of Fed speakers today preparing the market for what may be a slower pace of rate cuts in the coming quarters. Is this going to change your thinking in terms of the dollar's behavior?
Well, good morning, Doug. It could well do. I mean, we're at nearly that US dollar index sitting at 104. It's had a very strong rally over the last couple of weeks, been bid up and, naturally sell off as far as all the other currencies, euro, yen, they're coming under pressure. So I wouldn't be surprised for that to happen in the sense of delayed or pushing them out. There's still, a mixed view on the street as far as retail traders. Some are saying there's a portion that's saying we've got no cut at all in November, and a big percentage naturally are saying 25 basis points. So the jury's out. We've just got to see how it drops on the 7th.
I want to talk about the Aussie dollar as it relates to China, a lot of the stimulus measures that we have seen come out of Beijing recently. But in terms of the greenback right now, are you favoring it? If you had to go long a currency right now, would it be the U.S. dollar?
Well, you've got to be. I mean, over the last couple of weeks, it's been enormous because you've had a really strong push-ups from those September where we had the Aussie sitting, 68.5. It's now 66.5, being sold off, heavily. You've got Euro sitting 108.15. So there's more pressure there to the downside. I wouldn't be surprised if another rate cut for the Euro. So there's the general consensus is US dollar up and maybe even take a 104.50 out. It's just been strongly bid up, and you can't, from a currency trading perspective, Doug, you can't take your eye or focus off that because it just seems to have momentum at the moment.
How are you feeling about the Aussie, given a lot of the stimulus that has come out of China?
Well, look, I would have thought that maybe we may have touched possibly a 69, but it's been pushed all the way back. And, we are a bit of a proxy trade for China. We're all understanding what the situation is. And, naturally, the PBOC cutting rates yesterday, that had been widely expected. So, it's a choppy one. It's very volatile. If you want to ride a wild bronco, Aussie US dollar is the trade. It's like riding nat gas.
Are you tending to stay away from commodity currencies right now a little bit?
Well, you got to look at the Canadian dollar. It's fallen 2.6% from that September high. Kiwi's being crushed. So, look, we've still got a big appetite for them from our retail base, Doug. I mean, they trade at 24 hours a day, and they like the volatility. But you've just got to be very mindful of it from a risk perspective, because it is incredibly volatile. And but that doesn't necessarily shy traders away from the opportunity, because many traders, as you know, their risk management processes, they lock them in, and they just they trade the technicals.
Next week, we have a rate decision from the BoJ. There seems to have been a little bit of a policy pivot right now. Perhaps the BoJ slow walking the next rate hike. How are you feeling about what the BoJ may deliver?
Well, I'm thinking that we won't see a rate hike, and it's just, they might again push it out. You've got that yen has been, nearly 151, so it's been incredibly volatile. We've got a very strong stock market. The Nikkei's performed extremely well over the last 12 to 18 months. Everyone knows that. So it's a market you couldn't not be involved in. I think that, the situation in Japan is it'll be a push out, and we're not expecting anything dramatic to happen. But it's full of surprises, and I'm not going to say that it won't happen, but at the moment I'm more in the camp that it won't happen than will happen.
So even though the BoJ is signaling it may push out a rate hike, do we have to be worried about maybe a little bit of intervention from the Ministry of Finance when you're talking about a yen that's flirting with 151?
Yeah, I think so. I mean, it's always on the back of everyone's mind. If it was to tick higher, then naturally, if you get that 155, you could see some form of intervention. And you can't rule that out, because it was only a couple of weeks back. It was running at that 143, 144. So it's, again, an incredibly volatile trade, the yen dollar. And I wouldn't be surprised that you see it edge up even higher from here, maybe a 153 handle. Doug, you might even see a 154, but it's got momentum at the moment, and you can't stand in the road of it, because it'll run you over.
Let's take a step back, because one of the things we have yet to discuss is how the presidential election here in the U.S. may kind of interfere with the behavior of the foreign exchange. Is that likely? Could we see a little bit of a pickup in volatility as we get closer to the election, and maybe on the other side of it?
I would think so. First off, yes. So that I think the volatility will pick up, and we're only 2 weeks out. So I think that's how it'll play. And then after the election, well, yes, I won't be surprised. I mean, I'm very conscious as far as the meeting on this week, the IMF and World Bank meeting in Washington, D.C., and the commentary coming from MD Georgieva. I think we're going to see some major themes play out from a debt level, and that's what she's really focused on, and that'll happen, I feel, in the second half of this quarter. So it's going to be a dynamic quarter, and strap yourself in. There could be more volatility. You
mentioned the euro a short while ago. We're trading $1.08 against the greenback. A lot of weakness economically speaking on the continent. I mean, is this something that will persist into next year?
Yeah, I look at Germany, and I'm very conscious of the big picture. I mean, their manufacturing struggling, and even weak demand in China from for their finished goods. So for it to stay competitive, it's going to be a tough, hard ask. I'm conscious as far as the political turmoil in France and the uncertainty for business. So these are themes that will naturally impact ECB decision. We've had 3 rate cuts totaling 75 basis points. More easing naturally must be on the way, and you've got September's PMIs were so bad, it prompted an about turn by the ECB. So with these flash PMIs this week, Doug, I think that we've just got to see how it all falls.
So we've talked
over the next months.
Sorry, Peter. We've talked a little bit about the macro. We've talked about the presidential election. We've talked about the Fed and the BoJ. I'm wondering whether geopolitics enters your thinking these days, and whether or not you see it as being a driver of any of the movement in the foreign exchange.
Absolutely. I'm conscious as far as Taiwan Strait, Ukraine, Russia, Middle East. So these are major themes, and I feel as though that they're gaining momentum, which in turn could manifest pre-election. So there's something from a trading perspective, Doug, that we're very focused on. Soaring government debt's the other side, but that when you look at the geopolitical tensions, and there will be a safety to king dollar. You've seen that big run up as far as bullion price and silver. So we're conscious as far as a change of sentiment from this time last year as far as precious metals. And I feel as though that those geopolitical stresses are very, very major themes.
So the bull trend in gold continues.
Well, 2740. Wow. I mean, I don't think anyone, there were bullish analysts that said, we'll see 2,700 in the fourth quarter. I even said, you'll see 2,500 this year, earlier in the year. But I've been even amazed with the velocity of it. It's been unheralded. And I again won't be surprised if you told me it's 29.50 by Christmas. I'd go, okay, yeah, I won't be surprised at all. And so I just think it's got uplift at the moment.
I'm wondering if it's flashing a warning signal of any type that there may be a pocket in the market that really comes in or under a lot of stress, and gold may be sending that signal already.
You betcha. I think that's the case. I mean, a market that's up over 40% in a year. I mean, it's just mind-blowing. It's beaten the S&P. It's something that, and it's global. I mean, you're looking at retail investors across India, across Asia. The likes of Costco selling physical. You've got Australians buying, retail public are buying, ingots and gold and silver. So the appetite is there, and that seems to be a collective across pretty much the world, Doug.
Peter, thanks so much for taking the time to chat with us. It's always a pleasure. Peter McGuire is the CEO of XM Australia, joining us from Sydney on the Daybreak Asia podcast. This is Bloomberg Daybreak Asia, your morning brief on the stories making news from Hong Kong to Singapore and Wall Street. Look for us on your podcast feed every day on Apple, Spotify, and anywhere else you get your podcast. Our flagship New York station is also available on your Amazon Alexa devices. Just say, Alexa, play Bloomberg 1130. Plus, listen coast to coast on the Bloomberg Business app, Sirius XM, the iHeartRadio app, and on Bloomberg.com. I'm Doug Krisner. Join us again tomorrow for all the news you need to start your day right here on Bloomberg Daybreak Asia.